Welcome back to Behavioral Finance and FinTech. I'm Andy Kim, and here in this chapter we are reviewing or studying the definition of efficient market hypothesis and supporting evidence for EMH. Okay, so the definition, it goes like this. Eugene Fama, in his 1970 paper, said like this: an efficient capital market is a market that is efficient in processing information. It's all about the information, okay? And the prices of securities observed at any time are based on correct evaluations of all information available at that time. In an efficient market, prices fully reflect available information. That's his hypothesis, okay? Now that's hypothesis, but is there concrete evidence that prices always really reflect all the information? Well, is kind of there are many complicated issues to say clearly yes or no. Okay, so we're going to study about these complicated issues later. But Eugene Fama nicely describes a sophisticated way. He described this way: in reality, the prices move as if it reflects all the information. As if, okay, that's an important part. Now, EMH definition mathematically, assertion is like this: price that you observe should be equal to the true value, expected value of P star. Whatever the economists, right, want to say something true, okay, they, or first best or whatever, that ideally something has to happen, they represent it with a star on it, okay? If all the information about their cash flow and risk is reflected, then it should be P star, its expected value, okay? And it is the fundamental value, the present value of all cash flows that investors rationally expect to receive. Now, this is a DCF method, okay? Discounted cash flow method. So what do you do to get the true value? Okay, remember, this is not something observable with your eyes, okay? No, this is something you estimate with some errors, right? There's some error bound, okay? But on average, you will be correct, okay? On average, your average of your estimation should be the price that you observe in the market. You see the difference? The price is observable, but the true value is not observable, okay? That's why. So expected value, on average, you should be correct. Now, mathematically, how does it look like? Well, true value should be estimated in this way. It should be the summation, sigma, okay? Step by step, you add those expected future cash flow that is discounted at relevant cost of capital and in a compounded manner, okay? So expected return is a rational discount rate, okay? And it should reflect your risk aversion. That's what we mean when we say rational, okay? Rational people in economics, we assume that, the people are risk averse, okay? Indeed, we are, okay? Who likes risk anyway? Yeah, there are some, but usually, on average, we hate risk. That's why. And to the extent that all the information is reflected in the price already, it is impossible to predict return, price movement for the future. Price moves like a random walk. That's the claim, okay? Now, note that EMH does not say anything about which discount rate or cash flow expectation to use. It just gives you the framework that what the market uses is right. And then EMH asserts that P price equals to the best possible estimate of P star that can be made using a given information set, okay? So here's a quick check. According to Fama, can non-informational elements such as emotion, sentiment, or attention, can these things affect the stock price in a systematic manner? And the answer is no. Only information about the cash flow and risk will drive the price. attention, emotion, sentiment, bullshit, they will say. Okay, it does not affect the price. At least in a systematic manner, it does not move in that way. Okay, it's going to be just a random noise. Well, random noise means like it will be canceling each other out if you take the average. So that's Eugene Fama and the rational camp's argument. Okay, EMH guys, or you call it neoclassical finance guys. Okay. Number 2, if information is the only driver of stock price, the information should be about either what? 2 things. Either cash flow or risk. There's nothing else matters over there. Nothing else matters, just like Metallica, okay? Now, simple and clear. Wow, that's great, man. So 3 sets of information, we can think about it, okay? What kind of information is that? Well, public and past and then private information, we can think about those. You can think about 3 sets of information: past prices or returns, all publicly available information, or all public and private information. Okay, I'm assuming that past prices, they're all public anyway, so that's why. But past versus current. Okay, so and then private information. Now, these leads to 3 notions of market efficiency: progressively stronger, which is weak form, semi-strong form, and strong form. So weak form efficiency says all information in the past prices is efficiently included. Semi-strong form says that in addition to that, all public information current information is reflected, already reflected. Whatever you announce, okay, right now, as soon as you announce it, it's going to be priced right away. That's semi-strong form efficiency. Strong form, it says not only public announcements, but also company secrets like insider information. The information is also reflected in the price. So that's strong form efficiency. Now, one by one, weak form market efficiency. Let's go. This claim, all the past information, for example, the track record, the price chart, all these things, whatever happened in the past, the pattern that you find out in the past should be already reflected in the price, so much so that you cannot make money by studying the price pattern. So good luck, chartist, technical analyst, bye-bye, you should be laid off. That's the key message here, technical analysis. So technical analysis, by the way, what is it? So much so that the weak form market efficiency defies this notion. Who are those technical analysts? Chartists, right? What is their job? Okay, and they make money, by the way, so it's better to learn about what they do. Well, it's about visual pattern recognition. Visual pattern recognition. Looking at the chart, oh, this looks like a mountain. Okay, where's a trough, where's a peak, and all these kind of things. And the next peak will be somewhere, sometime in the future. So let's buy it right now. That's the idea of technical analysis. Anybody doing that technical analysis, by the way? Your eyes, man. It comes from our human nature or the evolution process. So ever since we were hunter-gatherer, okay, our ancestors, those who were better and faster in visual pattern recognition, had a better chance of survival. Make sense? And had a better chance of giving birth to their children and offsprings, leaving their offsprings. Why? Let's say you are going for rabbit hunting. Well, you have to be able to find out the different patterns between the grass, green grass, and maybe white, bubbly, jumpy rabbit pattern. So much so that those of the ancestors who are faster in this pattern recognition by just 1 millisecond, and then throwing out their axes, they had better chance of getting that rabbit and then feed their family. And then they had a better chance of mating, okay? Also, let's say you are hunting in the dark, somehow in the woods, okay, not the dark, but in the woods. You have to be fast in recognizing the patterns of the leaves, tree leaves, and then the pattern of the tigers. Otherwise, you're dead meat by now. So those who are faster in visual pattern recognition had a better chance of survival. Survival of the fittest, right? That's natural selection that happened. So much so that our brains are wired in such a way that we try to recognize any visual pattern and then distinguish some kind of things, whatever you see it. Hopefully that pattern is correct, okay? And like this, look at the graphs, charts, and we want to fit into our own belief or whatever picture that we want to, think about. And then this is a chart of some character called Kyungi, right? If the Kyungi, this guy raises his left hand, the price is gonna go up. If he's raising right hand, it's gonna go down. That kind of things. All kind of silly things happens, but there is some reason why, right? And then technical analysis. But EMH guys, why do they defy this notion? Let's say you got interested in Amazon.com and before clicking buy order, you see the price chart as below today. So up and down and up and down, this is today. So what would happen in your mind? Okay, pretty much like this. For example, no matter how good or bad you did in your high school math, in trigonometry, it does not matter. You will think about, sine and cosine function. And then it seems like it is combined together with some linear function, so much so that there seems to be some support line below which the price doesn't seem to go down. And there seems to be some resistance line over there above which the price never goes up. Okay, now we are here close to that support line. Oh, so if I buy it right now, maybe in 1 month, it's going to go to that resistance line. Then I will sell it. So I'm going to buy low and sell high. Yeah. And what do? Buy and hope and pray that it will get realized like this. Okay. But if you believe you are the only one doing this, no. You go to any bookstores and then their stock investment section, you will see this kind of books in Korea and also in America, guppy trading kind of things, right? The guppy trading, I intentionally opened up their index section, okay, keyword index. Could I find any keyword named information in this guppy trading? Information? No, they don't talk about information. Cash flow or discount rate or risk aversion? Never. All they care about is purely pattern recognition. Forget about economics and then just mathematically find the pattern somehow. Okay? Maybe you will bring some AIs to find out this pattern and then hope and pray things will work out. Good. Now, how does the economist argue for this kind of technical analysis? You are not alone. Michael Jackson comes in there, his famous song. Why? Okay, because everybody else is also as smart as you are. Okay, the market is full of geniuses anyway. So if your finding was correct, so much so that the price will go to that target level 1 month from now, then what should happen? Not only you, but also everybody else will think in the same way, okay? Because they can look at this chart anyway, okay? So everybody gets the same past information, and then they think in the same direction, just like you do, and then conclusion is the same. Then buy. Millions of people buy it simultaneously, so much so that the price should go up to the target level right away. Demand increases, price goes up. Quite natural, right? So much so that you don't have to wait 1 month, okay? But it should be already reflected over there and start to do random walk from then on. But the thing is, it's not there. The price is still here, okay? Which means, given that everybody is rational, your pattern recognition scheme is a bullshit, okay? That's the message here. Number 2, who says support line and who says, this is resistance line? Well, the beauty is in the eyes of the beholder. So it heavily depends on the time span you choose, okay? So if you expand the time span, okay? For example, the investing.com, you have a choice. Sometimes you can look at 1 week price chart, 3 months price chart, 1 year price chart, all the way up to maximum price chart, right? Depending on the time span that you specify, the pattern you recognize could be totally different, okay? For example, over here, you think this was a support line, but God knows, right? It could have been like this, right? So maybe you should return back to this original level. Then you're dead meat, man. So technical analysis, right? There's a limitation like that. So that's the argument of this, neoclassical finance guys. Now, so how to test whether this equality really holds? Okay. So testing weak form market efficiency, can we do that? Is an issue. Okay. Idea is to see whether using a given information set, one can forecast some abnormal returns above and beyond, right, the compensation of the risk that you take. Okay. Risk-adjusted returns, right? So time series-wise or cross-sectionally, you can test this hypothesis. So first thing first, weak form market efficiency, right? How can you test it? Well, exhaustively, you come up with a past price pattern recognition technique and then test using the data. We call it back testing. And rules like buy if price falls 10% in a week, buy low, and sell if it rises 10%, sell high. Well, this kind of things, if you try it with the past data, would you be able to make money? You can back test it. But the Eugene Pharma found that no, you cannot make any abnormal returns. And then the abnormal returns, what do you mean? Returns that on average, they're beating the appropriate discount rate benchmark, which is suggested by risk models. So easily put, the CAPM predicted models, right? CAPM benchmark returns and your realized returns, are they the same? The neoclassical finance guys say they are the same, so much so that when you subtract CAPM returns, nothing will be left. Abnormal returns will be 0. And that's what they precisely find. In that sense, right, weak form market efficiency, how can you also test it? In this way, past return and future returns. Run linear regression like this. We can do a formal regression test to see if trends like this, okay, should be there. Well, what does this test, right? Here we are trying to predict future returns of your stock by past returns of your stock. How do you know this is future return? How do you know it is past return? T-1 means time point before. One period before, T is this period. Okay, so past period, present period, which means relatively speaking, past and future. And then gamma is the coefficient. Okay, and then alpha is the intercept, something that is not explained by past returns. And epsilon, well, is a random noise. Okay, which is a white noise. If you take the average of epsilon, it's going to be 0. Alpha is not necessarily 0, but it's just the intercept, okay? Some certain level of return that you find, okay, in your data. That's A. It's not that important. What is important over here in this discussion is gamma. The last term is random noise. Weak form EMH predicts that the gamma is 0, which means past return has no predictability for future returns. That's the null hypothesis, and that null hypothesis supports weak form EMH. And Eugene Fama, in his research paper, tested this hypothesis and found out that gamma indeed is 0. Okay. Now, what are you talking about, Andy? Regression? That's kind of complicated. You may say. Let me give you an example of Samsung Electronics. So you can download Samsung Electronics daily return 1 year for students.xlx file over here. And then the question is, can we predict tomorrow's stock return by looking at yesterday's stock return? Okay. If we can, then market is not even weak form efficient. If we cannot, then market is weak form efficient, which means if we can reject the null hypothesis, then weak form market efficiency gets defined. But if we cannot reject the null hypothesis, then we can claim that weak form market efficiency is confirmed. Now, return. If you download this data, okay, you will see it, and then the return data of Samsung Electronics will be shown to you like this over here. And then this is the return, and that is lag return. Okay, today's return and yesterday's return. So past return, does that predict future return? Is our question. Okay, did I say yesterday and tomorrow? No, yesterday and today, I should say. Anyway, so that's the thing. Now, pictorially, I give you how the daily returns look like for Samsung Electronics. Last year until this year, day by day, returns was hovering around 0. Okay, sometimes positive, sometimes negative, and like this. Okay, that's today's the current day return, concurrent day return. If we overlap this picture with yesterday's return, how does it look like? It will look like this. You see past return, lag return in this, I don't know how to call this, turquoise color or something. And then it overlaps like this, but you see it like this. So using lag return, okay, does it have predictability for today's return? Okay. And for that purpose, I draw a plot, scatter plot like this. So the x-axis should be yesterday's return from here, and then y-axis has to be today's return that you see in a light green like this. Okay, so each day, okay, for example, here and there, there and there, you plot it and you see this yellow dots like this, and I run a linear regression to test whether the past return has any predictive power for future return. So our null hypothesis is that it does not have predictive power, in which case the slope of this regression line will be flat, almost flat. Okay, not precisely flat, but close to flat. Okay, reasonably close to flat. On the other hand, if the past return significantly predict future returns, the slope will be different from 0, like either positive or negative. Okay, so I run a regression, but before that, what I do is I add a trend line by right-clicking on the dots and then insert a trend line. So for example, here in this curve, what do? Remember, 2 columns, lag return and return, should be x and y. We take it as a rule in mathematics, right? It should be right item should be x-axis, left item is the x-axis, and right element in the coordinate is the y-axis coordinate. So what do? I insert something. Oh, I should download it into Excel file and then show it to you. So here is what I would do. Yeah, Samsung Electronics. For students, I show it to you here. So Excel spreadsheets shows up. Okay. Testing week 4 market efficiency just with one single stock. Okay, so I do select 2 columns like this and then insert a scatter plot like this. Okay, good. So what do? From here, I right click any dot and then insert a trend line like this. Second last item, and I say insert the formula of the estimated regression line, coefficients, and intercept, and show me the R squared over here. So R squared, okay, I told you before, 0.3, 0.2 R squared, it's okay. 0.10, fine, okay, this is finance. But here it's like 0.004. What does this tell us? The explanatory variable does not have significant predictive power for the right hand side, the left hand side variable, the y-axis variable. Okay, past return does not predict future returns. If you look at the R squared, too low. This is 0.0043. Okay, still there is some line we can draw by line estimation, right, in the regression line like this, and you find out the coefficients and intercept. Now, if we take the linear regression result, it will look like this. Okay, how do we do linear regression? We need data analysis, right? So what do? Just to show you about it, here is how I would do data, and then data analysis, and then here let's go to regression, 회귀 분석. I'm teaching you Korean. Anyway, so if I click yes, you will see the range of y variables and range of x variables. Remember, y variable should be on your right hand side. So this is it. From the label to the end, I say enter, and then x-axis variable should be this. I click this one and shift click lag return. Then I select the whole column of this variable and I check name tag, because the first item that I clicked is not the data but the label or the variable name. Okay, so I said yes. Then what do I get? The regression result. Again, all Korean words, sorry about this, but if it is your French or English version, you will find relevant words over there. Alternatively, you can translate this into your Google Translate or anyway. So what we care about is this part. R squared over there, we don't care about it, by the way. Okay, this is finance. And here, I don't like too many digits below decimal points. I would just leave it 3 digits below decimal point like this. And the regression coefficient, okay, looks like this. Lag return 0.066. That's, okay, let's see. This guy, 0.066. X, right? That's the slope term. And then the intercept, 0.088. That's this guy, okay? So exactly the same thing as long as you are running univariate regression. Univariate means one variable regression. Okay, you just have one variable as an explanatory variable. This one is a intercept, so it's just constant, right? You don't care about it. Univariate regression, one variable regression, results are shown. Now, we don't care about this R squared too much. I told you, too low. Now, what we care about is a t-statistic or p-value. So to simplify our discussion, let's look at the p-value. The significance level, okay? Let's put it 1% significance level. But the p-value is like 30%. So it's much bigger than our significance level of 1%. So we cannot reject the null hypothesis that This lag return has no predictive power about the future returns. So that supports our weak form efficient market hypothesis. So that's the evidence, okay? Just giving you one stock example for pedagogical purpose, but Eugene Fama and in this scholars, right? They were testing weak form market efficiency with many different countries' stock indices, and then and many thousands of hundreds of thousands of different stocks over tens of years of data, and they found out supporting evidence for weak form EMH. Past return does not have predictive power for future returns. Okay, that's an example. I hope you enjoyed this lecture. So the next slide, we're going to move down to the further discussion about weak form market efficiency and move on to semi-strong form efficiency. Thanks for watching.